Hey folks, welcome to Pro Trader Strategies, swing trades using options. My name's Eric Wilkinson, and let's get on with it. But before you go, what you need to know is make sure you subscribe and hit that bell right next to it so that you get a notification when I pop in here unannounced, or when we have technical difficulties like we just had. I started this video and I got booted. So we're going to try and start this all over again. For those of you who did subscribe, I can see you're starting to filter in here. Those of you who haven't subscribed, right there next to this subscribe, there's a bell that will tell you when I pop in unannounced. All right. And comment throughout the video. I'll be happy to make sure you guys are all clear of concept. Yes, I can see folks are starting to filter in here. You guys have subscribed. Thank you for doing that. And we'll get on with it. Sorry about the technical difficulties there. All right. Swing trades using options. These are more of the exotic strategies, folks. We are building on some of the basic option strategies to find some risk and create more of a nuanced strategy that tailors to our ultimate goal for this trade, okay? Because we don't always know the directionality, but we have a pretty good feeling of what we want and how we want to limit that risk. I'll show you how to do that through this video. So through these videos, though, I do build from simple concepts to real life examples. So we'll start with some really basic stuff and build on that. By the end of it, I think that you guys will have a solid understanding as to when, where, and why we would implement this strategy into any given assumption. All right. I wanted to pop in there on this because last time I had a bit of a mistake and started going a little bit further. All right, so with this video, we are going to be doing the short straddle. We're going to be doing the straddle, and we're going to define the risk, kind of throwing a covered call on that. Using that covered call, it limits our risk to the upside, and the location is going to eliminate all risk to the upside. And I'll show you how to do that here in a moment. But first, let's talk about swing trades just a little bit here. And what is swing trading? All right, we're talking about this in regards to, we're looking for different types of trends, right? Whether it's a bullish trend, a bearish trend, or a market neutral trend. Those are the different types of market action, if you will, that we usually see on any given day. So obviously a bullish market move gives you the next page. That's not a bullish market move there. What we're looking for here, though, is a bullish market move, right? A bearish market move, and or a market neutral type of action. But what we're seeing around that overarching trend is some ebbs and flows in the markets, right? Sometimes we get some big moves and some little moves. And then on a sideways trend, we can see it kind of doing that as well, right? Back and forth, ebbs and flows. All of them kind of very similar in nature, that we have those ebbs and flows, but they have a tendency to find the same support and resistance areas. Now, I like to get a little bit tighter on my support and resistance areas because I know that the market will have a tendency to blow through it a little bit, and I'm willing to take some heat. So if you have a higher risk tolerant trading regimen, then kind of pick the ones where you hit as many of the tops as you can. If you have a lower risk tolerant, you want to just try and maybe hit a few of them. All right. You're going to have less opportunities, but those ones aren't probably going to put you in the thumb screws. This would probably be where I would go, and then maybe somebody a little bit further out. All right. Again, tighter resistance, support, and maybe a wider resistance area. Okay. So then we find our support and resistances. That's really what we're looking for, because when the market comes down and bounces off of those, that's what we're looking for, is a pattern reversal off of those support and resistance areas, right? Off of the bouncing off of that support area, and that pattern reversal is what we're going to look for there. All right. Now, if we move on to a real life example, we have a neutral overall pattern here, or sorry, neutral overall trend. Now we're going to want to draw in to find, glaze our eyes, if you will. And when you squint them a little bit, you can see that you're going to kind of get something like this, right? Somewhat similar to what I was looking at. All right. And then kind of come in here and try and hit your resistance, find your support. That would be mine. I'm a little bit tighter, like I said. Somebody with a newer to trading or trading options, pick the outer band where you're not going to have as many opportunities, but you can see that those don't go through you as often. All right. So overall trend was neutral, found my support and resistances. Now I want to figure out what the pattern is, what's happening with the pattern. So when I do that, I'm looking for certain candles, and those candles are going to look like this. We've got a hammer doji. Basically, if the base is a little bit smaller where I'm covering in versus the wick, that's a key, all right? You want this to be a little bit smaller than the overall wick, less than 50% kind of idea. And then you could even have it where the wick comes out the bottom, right? It could even be a narrower band there. These are all red. They could be in green, and they would indicate the same thing, all right? At the top and bottoms of the moves. I'm not talking about in here. We don't care about in here. This is all messy. We want to see it when it comes up like this at the tops and bottoms of moves. Not very good one there. There's one right there. Another one right there. And we've got this one we're keying in on. But like I said, folks, these candles could be red or green, and they mean the same thing at the top of a bottom of a move. They can be a little bit bigger, a little bit smaller, you know, like having that a little bit narrower, right? We could have our top look like that, all right, and have it with a little wick, all right? So the body that is darker is usually a little bit smaller than the overall wick, all right? And you could have one that looks like that. That's a tombstone doji. Now, if you have a higher risk tolerance like I do, I usually trade off of this candle there, all right? That's what I'm looking for. Now, if you are newer to trading, you want to wait for the confirmation candle. What I'm showing you here with all of these candles is the setup candle, all right? These are all setup candles across the board. Everything's a setup candle. You would want to wait for a confirmation candle, which is a big red one at the top of a move, confirming that we are rolling over. It's got to close out below the previous day's low like that, all right? I don't know if you can see that in there that tight, but you want it to close out lower than the previous day's low. That would mean a confirmation of a pattern reversal, all right? So in this case, you would be looking for a big red candle right next to this candle, or a big red candle right next to this candle, okay? That would mean it's rolling over, all right? Vice versa, if you were looking at it at the bottom of a move, let's just say we had a candle that came down at the bottom of a move. I don't know why my pen didn't work on that. I had it set up. All right. So, you know, just down here, if I had gone like this and the market had, say, trailed off, right? And now I feel like it's kind of at the bottom of this move, I would be looking for this as a pattern reversal up. And then that's the setup candle. If you are newer to trading, I would wait for the confirmation candle, which would be a big green one like this. And again, this closes out above the high of that wick. That would be a confirmation of a reversal to the bullish side, all right? Does that make sense for everybody so far? So all of these candles are mutually kind of exclusive. You're not really looking at them as a combination of candles, which we will as we build on this type of candlestick trading idea. But for right now, as a newer trader, look for these specific candles for right now. Now, there's all kinds of other patterns that we can look for, and we'll go into that as we, you know, get used to and more accustomed to spotting these types of setups. We will, but you can see here, this was a really good one because we've got that top candle like that, and then the red confirmation right next to it. Okay. Now, what I was looking at was with this trend or this trade, and this one has a relatively bullish overall trend for the last year, right? We can see that's trending higher. We have gotten a bit of a correction, something to look for. We found support here, it will act as resistance again. I think we'll go through it. I look for this when we're at what I call the point of control, or what we trading around market profile, which is all this blue over here at the side. This is the market profile over here. This is a value area high and a value area low, which just means that most of the trading's been going on in between. And that's more of a comfort zone for everybody. If you think about your trading, well, when you've traded a stock price, you bought, say, Ulta at 363, and it just continues to trade here. Well, you don't really worry about it, either good or bad, right? It's not hurting you, so you don't worry about it to the downside, and it doesn't hurt you to the upside. But when you get to extremes, that's when people start feeling the pinch, when it's going against them. Point of control is where the most time and volume has been spent. So that acts as like a little bit of a magnet, all right, and is going to want to try and draw down the market, because if the point of control is where the most time and volume has been spent, that's where most people have traded that price. So you can assume, you can believe that when the market starts trading higher, those people that got short are really hurting. Or vice versa. If you got long at the point of control with everybody else and it starts going down, you can see that that is starting to hurt you. So you're going to be wanting to get out, all right? So when you get to those extremes, you start seeing some volatility and some panicking. Right now, we're kind of in the middle of this. I think we're going to settle down around this underlying. And I've got really high volatility, which means that the premiums associated to Ulta are really elevated as well. This chart down here tells me what my premiums look like in the option montage, because I know as a product of option theory that as volatility increases, there's a volatility coefficient, beta, associated to my options. And as beta increases, that makes those premiums increase incrementally, all right? So when I can look at this at the top here, I just know right off the bat, my premiums right now are the most expensive they've been in all of the option contracts associated to this underlying for the last year. So I know they could get more expensive, but most likely they are at the highest level there. All right, so that's when I want to take advantage of collecting a premium, meaning selling options. Yes, some people will say that that is a little bit more risk, but I would also tell you, then there is more reward. That is the levers and pulleys of trading, especially with options. The more risk you take, the more reward you are able to get, all right? Less risk, less reward, all right? Or less probability of that reward, all right? So why would we want to use options? Well, I kind of mentioned it a little bit in not so many words, but you're going to have better odds or better probabilities, all right? You're also going to carry less risk than if you had the outright or you were trading just stock, all right? You're going to have less risk because I'm going to be able to limit my risk by buying options. For one, I can create an opportunity that way, or when I'm selling options, I'm so far away, the probabilities of my strategy being tested are very small, like a 16% probability of, losing money. So those probabilities outweigh the risk in some regards. All right. Also, you're going to have lower margins, meaning that if you have a smaller account, you will be able to trade with the big boys in a sense. All right. If you know how to build this up. I mean, I show in some of these swing trade videos where we were doing synthetic longs and synthetic shorts, where we were building a strategy that would act just like the underlying, aside from paying dividends or stuff like that, but would act dollar for dollar in directional moves, just like the underlying, but we were using 50% less margin. All right. We gained the same, we lost the same, but we had to put up half as much. All right. So lower margins, and your risk most times. You will know what your risk is versus your reward. All right. Risk. When you're trading a stock, you don't always know what your risk versus your reward is. You've got targets set, you've got stops in place, But that stop could get executed at any price. It's in the open market. It could just free fall with the market. If there was a flash crash or something, you don't ever know where that stop is going to get filled. With options, I know exactly where I'm in and out at, which will let you keep your powder dry, folks. All right, so back to this example. We've kind of rallied forward a couple of days here, and we can see that guys like me that got involved on that candle without waiting for the confirmation, you can see it never got confirmed. The market rallied and closed above that high. So you folks out there that have a lower risk appetite, well, you were very happy on this one because you didn't lose money. Me, on the other hand, I was short 135 puts during this time. That's because volatility was really high. I knew I had premiums in there, and the market spiked against me. All right, but you can see the high was 137. It came up and pierced a couple of other resistance areas. This one where everybody else that is newer to trading would have gotten in, seen that beautiful candle at the top there, and then the confirmation candle and knew that they were golden. Well, I didn't get out of this trade. I knew my probability, so I stayed in it. So it ended up being a winning trade for me. But had I been short outright the stock, this would have been a very painful experience in that pop. All right, I probably would have puked out because of the market moving against me. But with the options, I knew my probabilities. I knew that the premiums were really expensive. That allowed me to get a much, even though I'm short the 135 or 137 puts, I got a premium that got me my break even well above even that high there. So never really angst about it. The market rolled over and we were able to cover that trade. And the reason why I use IBM so much, folks, is because it's a great trade for a newer trader, or a great underlying for a newer trader. There's a lot of volume and open interest in there, which means you don't have to really figure out what the option pricing is too much, like where am I going to enter the market. You can just give up a penny or two on the bid or offer and you'll get executed, or at least you'll get filled on that trade, I should say. I don't know what I was thinking there. Had a brain collapse. All right. So again, with newer trader, because this always has a tendency to come right back. Yeah, the high is 200 or something in IBM, but that only peaked up there for a blip moment several years ago. For the most part, it's been trading right around 125 for the last forever years. We have kind of reached that paradigm. It's somewhere between 125 and 150 is kind of the sweet spot. But when it gets down here in the teens, that's a buying opportunity. Up here in the 150s, you can see it just rolled back over and it's right back into that trend area where we were looking at from before. I think our area was right up in here, but you can see it's starting to want to migrate back to that. So you can play this trade. Again, IBM making that move from off those lows to the value area high. Nice little candle at the top there. What do you think it did? Started rolling back over again. You can take those trades with this quite often. Just have your support and resistances in there and you'll see it come to fruition like that. Now with our trade, we're looking for this to stay within the value areas here. All right. Then I'll get my profit. Anything above, I'm going to profit. Any sideways trade, I will have the max profit. So that's what I'm looking for. I'm looking for, I would get long. My idea when I'm looking at this trade, when you're doing this on a daily basis, right? I'm looking at maybe this in an IRA. I would get long down here at where everybody else finds value. Why wouldn't I find value there? Right around this 125-ish or 325-ish area. And then, I'm a little bit worried we break out above the value area high. We're going to retest the highs. Okay, so that's kind of my theory. For the most part, I believe we're going to stay right in and around this little volume node here and build that out. I think that's where we're going to start seeing more and more trades. So with that thesis, I'm not worried about the downside because I'm willing to buy it. Because remember, we're doing a short straddle, which means I'm selling a call, selling a put, and then I'm covering my upside risk by doing a covered call there. Okay. The downside, though, I have a short put that could theoretically have unlimited risk, folks. But I'm willing to have my break even come in around that 1 point of control. So therefore, if I'm willing to get long here, I want no risk to the upside. I believe wholeheartedly that it's going to stay here. Well, that's the perfect scenario for the short straddle with no upside risk. I mean, folks, talk to me. Throw it over there in the comment section. Don't you guys come up with theories like this where I'm looking at this underlying? Well, if it goes down, right down to here to this point of control, I'd be willing to buy that stock down there. So if you sell puts, that's the best way to get long stock in my eyes, because if it doesn't go down there and doesn't get put to you, then you get to keep the premium. If it does and it goes down to the strike location you were willing to buy it, then you should be happy as a pig in mud because you got long at your price that you picked and somebody paid you that premium, right? By selling puts, you get collection of premium. You can continuously do that. So I want to get long down here. I don't want any risk if it starts breaking out and breaks through my theory of really just trading around this little area right here, okay? So with that said, we're going to look at the short straddle with no upside risk because of that theory, and I've got really high volatility. You know, my thesis really is determined by this volatility, right? If I had that same kind of scenario, then maybe I would just do a long call, right? If I wanted to take advantage of this type of bullish move and still worried about the downside. I wouldn't get long the underlying by doing that, but I could still take advantage of a bullish move. I would never do that, though. I would never do a long call when we've got volatility at this level. Why? Because I know the premiums are super expensive. Why would I want to buy something at the high, right? No. I want to buy something when it's at the low, and that means when we're buying options, you would want to be buying it down here. Buying options when volatility is down there. All right, so I told you, we're starting out with a straddle because we have that volatility. Here is Vega that I was talking about. That's implied volatility, folks. That's all this is it's a fancy word for implied vol. All right, Vega, volatility. And what I was talking about is when this number increases by 1 percentage point. All right, we increase by 1 percentage point. All of these premiums are going to increase by the corresponding coefficient, meaning 51 cents will go into that premium on both a bid and offer for every 1 percentage point increase. And I'm telling you, folks, these things will move at 10% increments. Sorry. So that would be like a $5 move there. Again, we got volatility over here in this column, volatility coefficient, 1 percentage point increase, premiums increase by that coefficient. 1% decrease, all else being equal, not even a minute has passed by, the underlying didn't move a penny, just 1 percentage point decrease, all my premiums drop by the corresponding coefficient, all right? So if volatility goes down, those premiums go down. And that's what I'm looking for when I have really high volatility, right? I think it's at its highest level or very near it. I therefore believe that the underlying is going to go, or the volatility coefficient is going to go down in value, right? And if it goes down in value, then those premiums start decreasing. That means I'm more profitable if I've sold it. I can sell high and buy low. So what we want to do is start out with the at the money straddle, right? And I get a collection of credit, $46.40. Now, how do I define that risk to the upside? Well, what I need to do is try and find the option that will allow me to still have enough credit to cover that distance. So in this case, with that 65, if I were just to look at this as the straddle, you can see that my max profit is that $4,640 or $4,640, but I have unlimited risk in both directions. If it stays right here at 165 or 365, then I get the max profit on it. But if it breaks outside of that, I can figure my break even is $46 plus the calls. That's my break even to the upside. So $46 plus the 65 gives me $410 to the upside ish, right? That's my break even to the upside. I just add in my credit to the strike price. That's my break even to the upside. And then to the downside, my break even is the $46 minus the 65, which gives me right around, what is that, 319-ish. All right. To the downside, those are my two break evens. Outside of that, it's either going to get called away from me to the upside or put to me to the downside, meaning I would have to buy that stock. So $46. I need to look for a strike. This is my straddle right here at the 6.5. I don't know why it's highlighting something below there, but right here's my strikes that I'm looking for at the money, the 50-ish delta, right? The closest to 50-50 delta I can get, which is just slightly higher than where we were. And I collected that $46. Now I would look out, like, see where I could figure I can buy an option to find the risk. And if I go out and buy a $10 stock or $10 option from $46 minus 10 gives me $36 or $37 in this case. But I bought a $10 option, and it's the distance here between these two is $35, right? Well, $35 distance, but look at my credit. It's $37. So that tells me that I've defined the risk to the upside, and if it goes any higher than that short strike, I still get to keep a profit there, all right? You know, it's only going to be a couple of dollars above that strike, but my break even here, if I added my break evens to the upside, you can see $37 plus 365 puts me at 402. So anything above this, if I go above there, then I basically have a $2 profit no matter what, because I lost money on the short spread, right? On the short call spread, short call, long call. It's $35. I would have lost $35 on that short call spread, but I've collected a total of $37. You guys all following me there? $37 is more than 35, so I get that upside in my pocket. So this is what it would look like. You can see this is basically the gap is my $2, right? This is that $2 gap. And if we started out here at the 365s, right? 365 strike, short call, short put. I start moving higher. As I move higher, this is that short call spread because I got a short call right here. And as it goes up here, this short call is increasing in value, which hurts, but I've defined the risk here at the long call. So as we move higher, it's eating into my credit, and I'm losing a little bit of money from that credit, but it can't eat up all the credit because I've defined it inside of where that big credit is. Now, it did, as you see, I mean, our old break even was around 319, I think it was. So you can see that our break even has moved this way a little bit. Anytime you reduce risk on one side, you're adding risk to the other side. So, but I talked about that price right around that 325 area was the area I'd be willing to get long. So it's 327, $2. I'd be willing to give up that to get this strategy on and get that collection of credit. So all of these things I'm looking to play out here. As a matter of fact, I think if we pulled up the chart today, it's working out. My platform closed down. I had to shut my platform down because the last time we tried to go live here, it blew it off. So I was wondering if I was just running too many things in the background. So at the end of the day, you can see that we've had an Ulta turn up in the market. It's still within those parameters. It's right there at around 370. So that's where I thought it would kind of start stalling out. It might roll back over, but I do think that my thesis is still intact from a couple of days ago when I started coming up with this theory on this trade. And that's about it. If nobody else has any more questions, I am about done here. One thing I wanted to talk about, though, with this strategy, with those break evens, remember when we were talking about that 27 here, this little area, we did bring in that side of it, but that 327 strike in the option montage over there, when I set this up, that 327 area, that level at 327 was equal to about a 23 delta. Okay. That 37, this was a put. So that put was at 327 or 325 put. I think it was actually that 325 put was right around a 23 delta. So when we're looking at this overall trade again, remember, we started out with that $37. That collection of credit allowed us to have no risk to the upside. So that's telling me if my break even now is all the way down here at 325, that's the only place I have risk is below 327. Let's call it 327, 325. That's the only place I have risk is below this delta. So here's a overall risk parameter curve, bell curve, however you want to look at it. And these are our standard deviations. You hear of standard deviations a lot in trading options. Well, it's because they're very important. If you were to add up everything basically from this mark that way, right? I add up the 9, the 4, and the 1 point, and then all the way out here. Basically, we come up to what is very close to a 16 delta. And then this line usually is somewhere around a 34 delta. All right. We know that from standard deviation curves. Now, if I'm looking for a 23 delta, that's telling me it's going to land somewhere right in here. Let's just call that the 23 delta. I'm trying to write sideways. 23 delta. All right. So that means my risk is down here. My risk is anything this way. And my reward is everything in the opposite direction, right? That means that this is start date. This is when we put on the trade, right? That's basically where we're looking at my 365 straddle. So that means the market can go down all the way to here. So everything above that this way is a win. So I have a 77% probability of success because I can keep that $2 if it goes pretty high. All right. So that's why this is important, especially with the high volatility. You want to make sure you collect that credit rather than pay out, because if volatility really starts, we saw that volatility coefficient up here. That volatility coefficient just craters, and I bought calls up here. But even if the underlying went higher, I've got this volatility offsetting it. And you saw in that other option montage, that volatility in some regards can be bigger than the delta. So this delta being smaller on both of these, the Vega here is about even. So this delta means for every dollar move, your premiums will increase by that amount and a percentage point here. So if the underlying increased by $1 and volatility went down by 1 percentage point, I would be in the same place. The premiums wouldn't have changed. I wouldn't even know any different. If it moved up exactly $1 and volatility downticked 1 percentage point at the same time, it would offset one another. So we don't want to get into a situation like that. What's the criteria for the upside call purchase? So this upside call, I need to make sure when I'm buying it, it's usually going to be right around a 30 delta is your first clue. It's right around a 30 to a 20 some odd delta. So to the upside, to the upside, we're just trying to find that option we can buy and still have a credit to cover that distance. Does that make sense? So I had $46. I knew if I went $35 higher, it was going to be somewhere right around there in that $10. because I was just kind of doing the math in my head, figuring $46. I can't go $46 higher because I'm still going to have to pay for something, right? That's going to make me have risk to the upside. So I had to do a little bit of math here in my head to figure that one out. I had $46. I knew, all right, let's go $36 higher. I played around with a couple of different strikes before I finally found it. So, but ultimately, because it's only $35 wide and I've collected $35 wide, collected $37, that means that short call spread, or the short call with the long call, is inside of that premium. So I'm free and clear. All right. All right. And then that's it. This is the entire package all jammed together for your short straddle with no upside risk. Make sure that your collection of credit is more than the width of that defined risk area. All right. I don't know why I had all those other ones. All right, guys, here's your offer for the day. You guys can take advantage of this for $36. It will save you a lot more than that. I can almost assure you, with over 15 hours of content. You're going to learn how to trade around that market profile, which is key to helping you figure out when the support and resistances are even more defined. If you got a value area high lined up with one of your Fibonacci's, those are ones where we used to call them olive lines for the support and resistance, when you get the double banger on there. And I've thrown this link over in the side. And before you guys go, I know a lot of you guys filtered back in here. For those of you guys kind of found it by searching around again and again, subscribe and hit the bell right next to it, because the bell tells you when I pop in and announce. Today I was announced, but we had some technical difficulties, and now I've got those hopefully figured out anyway going forward. I will circle back around for you folks to comment, make sure everybody's clear of concept there, and smash that like button before you go. It does help us out. It feeds those bots to run out and find somebody like you to share this content with. Finally, if you can't take that, take it easy.